Welcome to the Daily Brief, where I'll go over the action in the market for Wednesday, January 18th, and then we'll see how things look for Thursday, January 19th. We had a pretty positive open, but not long after that, the shift went from maybe things are going to get a little better, maybe the Fed's going to slow down with their rate increases, to, oh my gosh, there's some real growth concerns here. We better sell what we have. And everything reversed and went down, and we ended up having a pretty significant down day. It hasn't done an awful lot to change the overall technical picture. Yes, if it continues, we will turn more negative, and we may be doing that. But for right now, we've just worked off the short and intermediate term overbought condition. Things are still fairly positive, and so now we have to ask ourselves, is the market going to make it another try to get above that trend line? That seems to be the overhead resistance. You can throw whatever you want at the market, but when you're looking at the chart and we're seeing that downward sloping trend line, we come right up to that and so far have rejected that level. Now, will the market just back down like it has before and start to decline? Or are we going to give it another run at some point to try to get above that level? So let's go back and talk about what happened. Right at the open, we did have a gap higher open. We were up about 0.5% right at the open, and prices climbed up to R1 at 4,009. And then prices started to retrace, which is very common. But then we got down below the daily pivot at 39.97, and we went down below the unchanged level, which often acts as support. Well, we just kept going. As the day went on, we saw more broad-based selling. This is where everybody started to get involved in this. We drove prices down below S1 at 39.79. Then we went down below S2 at 39.66. Then we even went down to S3 and dropped below that at 39.35. And we closed almost at the low for the session. We were down 1.56%, and volume was still above average. Now, our technicals, as I said, they're still leaning more positive, but if we see follow-through selling, they're going to switch over more negative, and it has to do with these growth concerns. We also have a lot of companies that are coming out with their earnings, and that can have an impact on the market. And there was a lot of news that came out, like Microsoft is going to be letting people go, and other news that hits the market, and they decide to take that and direct it towards the entire market, where usually something like that, when a company's letting people go, their stock tends to go up because that means there's fewer people they have to pay. And so they might have more profits. Well, it's being seen as the other way right now. And then we have also had some Fed speak in Wednesday's session that I'll go through. So here is the chart showing how we gapped higher right at the open. We went up to R1, even a little bit above that, but that really was the overhead resistance level. We came back down, filled the gap, dropped below the unchanged level, and that's, instead of bouncing back up, which happens quite often, we just kept going down to S1, then down to S2. We chopped down and pretty much were going sideways for a while, but then fell down below S3 going into the close, and then closed even below that. So what are some comments that we can make? First of all, we have to say that yes, indeed, the market has been dealing with this trend line resistance, and that stopped the rally. We came up to that level and then turned and went back down. So will the market try to do that again at some point, or are we going to leave that in the dust now and then continue to head lower? The latest scenario that the Fed, of having them slow their raising interest rates, that was replaced by, oh my gosh, we have growth concerns now. And St. Louis Fed President Boulard came out. This was a scheduled interview that he did. He said that he would prefer that the Fed stay on a more aggressive path, but that the prospects for a soft landing have improved. Basically, where you stop raising interest rates without damaging the economy. That's what they consider to be a soft landing. Everybody's trying to shoot for that. That's the Fed's real goal. It's kind of happened once, maybe back in 1994, but technically, I've never really seen one. It's like with the Fed raising interest rates as aggressively as they have, and with the lag time for these Fed rates to work their way through the system, there hasn't been enough time to really evaluate that, and we probably could see some more growth concerns to the point of driving us into a recession. That's what the market is predicting, and that's what most people are saying. Nevertheless, copper keeps hanging on to its gains that I'll show you here in a moment. But this is what the Fed is trying to do, even though it's almost an impossible task in my view. The S&P did lose its 200-day moving average, so now we're down below that, and a long-term view has now switched back to negative. And right now, the 200-day simple moving average is at about the 39.75 level. The dollar was down a little bit. It was up for a lot of the session, but then as we got closer to the close, it gave up a lot of those gains. And interest rates were down. So both of these together should have given some support to stocks, but it didn't do that in Wednesday's session. And copper, is, even though it was down, it's still maintaining a lot of the gains that it's been seeing. We still have some of the stochastics, the intermediate term, short term version of the chart is still looking extreme positive, but other than that, everything else has been worked off. There's nothing more now in the intermediate term or in the long term. We still have the yield curves that are inverted, specifically the 10-year to the 2-year and the 10-year to the 3-month. Those are the ones that people really pay attention to. Sentiment has dropped a little bit, but it's still positive. It's giving us a reading of 57. It had been at 69. And then we had this whole slew of economic reports that came out. One of the reports that we get each week is the MBA Mortgage Applications Index, and this was up pretty strong. It was at 27.9%, where last week it was up 1.2%. The PPI, this was a real big one. They expected it to be down 0.1%. It came in down 0.5%, so that was weaker than expected. The last time it was up 0.2%. If you look at the core PPI, it was up 0.1% as expected, and lower than last time where it was up 0.2%. Retail sales, this also kind of gave a real shock to the market. We were down 1.1% where they expected it to be down 0.8%. The last time we had this report, it was down 1%. If you take out automobiles, retail sales were still down 1.1% where they expected it to be down 0.5%. Last time it was down 6%. So this is showing some real economic weakness. Industrial production declined 0.7%, much more than the 0.1% they had expected. The last time it was down 0.6%, so they expected it to improve, but it didn't. Capacity utilization, which is how much of the factories are being used, it came in at 78.8%. They expected it to be at 79.6%. That was weaker than expected and lower than the prior reading of 79.4%. Business inventories were up 0.4% as expected, a little bit more than the last time when we saw this come in at 0.3%. NAHB, the housing market, it came in with a reading of 35, which is greater than expected. So we're seeing a little bit of a bounce back, at least this week, with the applications and with the housing market. They expected it to come in at 31, and last time it came in at 31. So our trend is still positive overall. The green line's on top, even though it's declining, and it's still going up overall. So we're seeing a strengthening trend, but we continue to be below 20. Our bias is now negative with the down day that we had, and I've switched our momentum over to mixed. We could still recuperate from this, but looking at it on a chart, are we just beginning this pretty deliberate fall, or is the market going to be able to stabilize and try to go back higher? Here is a chart of the PPI just showing the total reading, which is in red, how it's been declining. And the goods, after really shooting up, everything has been declining here as well as the services. So this just gives you a graphical idea of how things have been declining or weakening with the producer price index. And we're seeing that across all the different economic reports that we're getting. Here is the chart that I've been showing for a while. Now we have to ask, are we going to go back and pick up this yellow price pattern that suggests that we might see weakness going forward? And then we have another chart as well that also suggests that we might see weakness going forward. Now the market could break this pattern at any time, and it looked like it was doing that. But now with the down day, we have to go, maybe it's not going to break that. Because even when prices went lower, you see, they didn't go straight down. Well, they did kind of here near the end. But they bounce around. They chop around. And so depending on what mood the market is in at any given time, we could take this and go, yeah, we think the market's going to follow this, or no, it's not. Here's another screenshot that I got from Twitter. This is showing how the earnings estimates for the S&P continue to drop, and that is ultimately what feeds through to stock prices. Looking at our VIX SPX correlation, it's still continuing to drop overall. And so this might give some support to the market. We don't know. Is Wednesday just an anomaly, or is this the beginning of a real shift in the actual trend? The Ulster Index still is showing that we're relatively complacent overall. We're not seeing a lot of fear coming into the market right now. The equity put call ratio declined on a down day. That's strange. We go down 1.5%. You would expect more people to load up on puts than they are on calls, but that didn't happen. Maybe a lot of those came from a while back when people did really load up on puts. So we're still seeing a decline overall of the equity put call ratio on the daily chart, and it's pretty much flat, but still declining overall on our 5-day simple moving average. This is showing where we had the spike and we came down, and now we're down below this red line, and sometimes that does give some support to the S&P. So we're still kind of hanging on to that for right now. The VIX ticked up a little bit. It got back above 20 as far as the closing basis is concerned, and the bar chart also increased, but it's still giving us a pretty low reading overall. And this is what a lot of people are starting to cite, that the market's up against resistance. It was a little bit overbought in the short term and intermediate term. There's not a lot of fear in the market. It's due to go down. And that's what a lot of people were rationalizing for in Wednesday's session. Now we have to see, because the VIX is still giving us a pretty low reading, is that going to produce more fear into the market by seeing more selling? Here's the VIX of the VIX showing how it's starting to increase with the bar chart and on the line chart. So we're seeing volatility pick up a little bit, but it's still low overall. Here is our trend. Even though the ADX turned down a little bit, it's still above the moving average. So we still count that as strengthening, but it could be weakening because it's seeing that red line start to pick up quite a bit and the green line coming down. Well, it was measuring that we were going in a positive direction. Now with this reversing, we see the ADX rolling over a little bit, but until it drops below the moving average, we still say this is a strengthening trend. However, overall, we are still below 20. And then here's the stochastics. We're short term. We're no longer extreme. We're still extreme with the intermediate short term, and we're still improving with the long short term chart. Stoch RSI, no longer extreme. Williams percent R, no longer extreme. CCI, no longer extreme on the 14 period, and just coming down from an extreme reading on the CCI 20. The BPI continues to show some improvement with the positive open that we had. That added a little bit to the PPI, and then it didn't really pick up the selling. So this is still positive overall. Here's a look at the daily chart showing how we came right up to this downward trend line. And now, so far, we've rejected it. We fell back below the 200-day moving average, and we're coming down close to the 50-period moving average. And then down below, you see where we were slightly above average with the volume. And here's our short-term fib level. Came right up to resistance at about the 4,006 level, rejected that, and is now starting to come back down. Are we going to go back up and test that again, or are we going to continue to fall, or are we going to continue to bounce sideways? Here's a longer term look. Also, we never quite made it up to this 4,020 level, which is overhead resistance, before coming back down. That's because the trend line basically was hit before this resistance level was. And so we'll have to ask the same question. Are we going to continue to go down and hit these other fib levels, or are we going to try to turn and go back up, or are we going to chop sideways for a while? The Swindlen Trading Oscillator, based on price and volume, is showing some weakness after giving us an extreme positive reading based on volume. And our moving average tree, we lost both of the 200-day moving averages. We're coming back down now into this mess and seeing, can we hang on to that 50-period moving average? The 100-day moving average is also in this whole mix. The CMB Composite Index, after giving us an extreme positive reading, has now working that off. And once we drop below this red line, that would be a sell signal, and then it would be confirmed if we drop below the green line. We're now back below the 200-day simple moving average. And then our Elder Impulse, it switched back to neutral for the S&P. where it's actually switched to negative with the Dow, and I'll show you that in a moment, where the McClellan oscillator is now dropping and has gone just slightly below zero. So that's turning a little bit more negative. But our new highs, new lows continue to advance with the positive open that registered some new highs, but we are decreasing here. But overall, our 5 period is going up and our 10 period continues to advance. Advanced decline line, we went down, but we're still looking positive overall based on price. We dropped down below the moving average based on volume. Then our longer term moving average steady, no longer extreme with the 50 or 150, and we're turning back down now with the 200-day moving average steady. Here's the home builders holding up fairly well, even though we had a drop in the S&P. Home builders did decline as well. The ratio is still holding up fairly well right here, and they're still having a tendency to go in the same direction. Copic curve, still working off of a buy signal that was generated recently, and the Pring bottom fisher, also a recent buy signal. We're back into the middle part of our trend channel, just about at the midpoint currently. And here's the Dow, where it dropped down. We fell below the pivot. It also dropped below its 50 period moving average. And here's the Elder Impulse, where it's now switched to a red bar. The mid caps also had a pretty rough day, but they're still coming off of a recent golden cross, and they're still above both the 50 and 200-day moving averages. And the Elder Impulse for the Qs has now switched back to neutral. So you have neutral for the S&P and the Qs, negative now for the Dow, and the Dow is the index that had been holding up the best going back to last fall. Copper, even though it had kind of spiked up here and it's coming back down, it did advance again, and it so far has been holding on to these gains that we've been seeing, which may suggest that the economy is looking better when you look out into the future. And then looking at the 10-year to the 3-month, I just wanted to bring this up because it's really dropping. This yield curve, it's not only inverted, but it's getting massively inverted. And you go back to 2008 in there, it's even more inverted than that. It's even more inverted now than it was during the dot-com bust in the early 2000s. Looking at our possible positive scenarios, these actually held up a little bit better than you would think. We're still positive with the 5-day moving average of the highs minus the lows. That's still going up slightly. And our sector rotation is actually holding up. Growth was down less than value in Wednesday's session. So we're seeing some improvement with the Qs to the S&P, discretionary to the S&P, and large cap growth against large cap value. Looking at the different growth value ratios, large caps continue to improve. We're seeing some improvement with the mid caps and a little bit of improvement with the small caps. And then our 2-year treasury, even though the S&P was down, interest rates were also down. So we're still trying to decide, is this a valid spike? Will this give some short to intermediate term support to the market? The small cap index, after giving us a recent golden cross, has now dropped back down below R1, the pivot level. And we'll have to see, is this just an anomaly, or are we going to see some follow-through buying after this decline? The ratio between the small caps and the S&P, it's continuing. Even though the S&P was down, the small caps were down less. We're seeing small caps continue to outperform. This could give some support. So the red line going up could give some support to the blue line, which is the S&P 500. And then we saw a real decline in staples. So this is still looking like it could be a valid spike. We've really been coming down, and a lot of times that gives some really good support to the S&P. So there's still some positive things out there. We just need to see now, is the market going to turn around and go back up and try to hit that trend line again, or are we going to see a further deterioration of our technical picture and turn back more negative? So what's our outlook? The technicals are still positive, but they could be turning negative. We can't just say, oh, well, we had a 1.5% decline and everything is still fine. It's still looking okay, but now we have to see what's the market going to do going forward. And that's another reason why I always wait till the end of the day when I'm doing trend-based strategies. The economic reports coming out on Thursday, we have the weekly jobless claims, housing starts, building permits, and the Philadelphia Fed Index will be coming out. And then our whole list of geopolitical events with earnings really coming into the picture, some corporate news from time to time, which quite often comes in conjunction with earnings reports. But the market itself is really fixated on this inflation and interest rate scenario, and now shifting back over to this earnings per share valuation concern that they've been having, which could really drive prices lower. Looking at the stock market almanac statistics for January 19th, we see that not really anything definitive is really given for the day. The Dow has been up 47.6% of the time, so that's more neutral to even negative since it's below 50%, where the S&P is giving us the same reading. The Nasdaq's a little bit more positive, from neutral to positive, because it's up 52.4% of the time. Then the other things that I've been mentioning, I'm not going to take the time to go through that. If you want to just pause this and see some of the other videos where I talk more about some of the statistics and probabilities that are going on within the market. Our scenarios can't really go with the downwind yet because our technicals are still positive, but we might be getting ready to turn negative. It's really difficult to go with the positive scenario now after seeing the decline that we saw, and we might be switching back over to negative. We've lost the 200-day moving average. The 50 could be next. If we continue to fall, we have to see, are we going to hang on to some pivot levels? If we go back up, we have fib retracements. We have a lot of resistance above where we're at currently. So we're still going with the sideways. Even though the ADX came down a little bit, it's still above that moving average, but it's below 20. It is positive with the green line on top, but we're going with the neutral to sideways trend. So our conclusion, the S&P is positive but showing weakness naturally. Now we want to see where do we go from here, basically. In the short term, we are still positive, but we might be getting ready to turn negative. Same thing with the intermediate term. Long term, we switch back to negative because we've dropped below the 200-day simple moving average. Thank you. Have a wonderful day on Thursday, and we'll just keep a close eye on things and then do the next video and try to make our evaluation of where the market stands.